And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Concerns about a wider conflict in the Middle East are mixing with the existing concern on sticky inflation. It's creating a very difficult stew for investors. Now, what, if anything, might do well in an uncertain environment like this? Let's talk about the reflation trade with Jan van Eck. He's the CEO of Van Eck, and Mike Akins from ETF Action. Gentlemen, thanks for joining me. Jan, you run a well-known commodity trading firm. This guy has a large suite of ETFs for gold, silver, energy, steel, other commodities. The reflation trade's done great this year. You made the point that global manufacturing is ticking higher. That seems to be the key point. That's driving this reflation trade. Explain what's going on.
Yeah, I think there's some powerful investable trends. Kind of the stuff coming out of the Middle East is hard to predict on a day-to-day basis. But there was a big change that happened in the first quarter, which was that the world economy started growing again. And the best measure I like for that is PMIs. They ticked above 50. And more importantly, China, which had been such a huge driver of growth and so negative for growth over the last year or two, manufacturing PMI is now positive in China as of March, and surprisingly positive. Like, this isn't like a little bit of a statistical move. You now have growth. The world economy is growing, so that leads to your reflation trade.
So that's what's driving commodities. Now, I think we have a chart here, an index of investable commodities is out there. That's the S&P GSCI. I don't know if we can put that up. That's advanced, what, 12, 13, 14% this year, outpacing the S&P 500 up, what, 9%. So copper and oil have had big gains as well, respectively, and that's reflected. Here it is. There you go, John.
Yep.
Look at the move up there. This is a basket of global commodities. That's moving because manufacturing has been improving.
The global PMI is not just manufacturing, it's both services and manufacturing. Yeah. China is just manufacturing because their services is always growing because they're moving from being a manufacturing to a services economy. But no, that's it. It's copper, Dr. Copper, they say that because it's a good measure of global economic growth. And energy prices probably have gotten a little bit ahead of themselves, but they're reflecting the world is growing.
Now, how does higher interest rates play in here? What role does that play in the whole reflation trade? And can that trade still keep going? I mean, I bring this up all the time, and they say, well, that's nice, Bob, but oil's already had a big move this year, for example. Just explain interest rates and how it plays into the mix here.
I think that's a great point because people in America look very short term, I think, and they're really focused on Fed policy. The reason I think that we're seeing growth and inflation in the United States is because, and I missed this for quite a while, is fiscal spending is running so super hot. It's crazy. We're running a 6.5% budget deficit, and that's what's causing inflation. It's the government spending, and I think that's leading to this global growth trade too. So that's why I like commodities, because I think it's more than just a headline. I think these trends are medium term.
Mike, we used to have Goldilocks a while ago. We had a strong economy, we had earnings growth, and inflation was trending down. Now we still have a strong economy, and we still have earnings growth, at least projected for this year, but now we've got this sticky inflation problem. So how does this play into the world you're looking at, the ETF world? How does sticky inflation and the reflation mix with these Middle East concerns, and what are you seeing in terms of flows for ETFs?
Yeah, on a flows basis, we're seeing year to date, it was primarily driven by technology. Growth equities were driving all of the flows across the board. Over the past month, though, we've seen that a little bit reverse, especially across the commodity trades, whether you're looking at like commodity ETFs have turned positive over the past month. Year to date, they're still negative, but they've turned positive. And also, if you look across the equity sectors of the market, energy is the second highest inflower from a ETF perspective, energy ETFs over the past month. They're still negative, barely year to date, but we've seen a big trend coming back into some of those more sensitive commodity-driven sectors of the market. And if you look through it to kind of an industry level, you're seeing that play out in natural resources and some of the exploration and commodity-driven hard asset producers within the sector ETFs. So I think from that perspective, go ahead,
Mike. I'm sorry, finish your point.
I was going to say, well, I think one of the big things that's different now than, say, 3 years ago when we had this kind of inflation crisis is that at that time, the fundamentals for the hard producing commodity sectors were really broken down. You looked at, like, if we rate ETFs on a quality basis, and energy 3 years ago had the worst quality rating out of the 11 GIC sectors. Today it's the second highest quality rating. So I think you've seen over the last 3 years a situation where these energy equity ETFs have really cleaned up their balance sheets, and now if we can see some sort of that growth demand, and you can see an increase in their margins, it's likely to go through to that bottom line, because if you look at the quality metrics and they're still trading at a much lower discount relative to the overall market, it sets up nice for this area of the market.
Mike brings up a very interesting point, because his point here is, just recently have we seen little upticks in energy. When I look at flows on the yearly basis, where the money is going, it's still into technology. Your Van Eck Semi still gets inflows. When energy ETFs have not seen big inflows at all, even with energy up 18% this year. That's amazing to me. Why are investors not showing any love for energy or commodities when that's what's moving? Usually they follow the trend, and they don't seem to be doing that.
Because it's a recent phenomenon. I mean, flows, buyers like higher, right? So only when prices started ticking up, and this news is fresh. That's why I'd like to focus on it. Like this China PMI data, this is only March data. It came out a couple of days ago. And so I think investors are now starting to focus on it. And I think also, yes, the companies are higher quality, meaning they fix their financial situation, but there's still some headwinds. There's a lot of regulation in Africa and Latin America that have been trying to take renegotiate the profit share with some of these producers. So that's favored the United States and Canada. So there's still some internal headwinds with that sector, and it's hard to compete with technology. So investors, I don't think, are really looking at these allocations yet.
Well, what is energy is what? 7% of the S&P 500. What is a sensible weighting to energy stocks in a diversified global portfolio? The investors seem to have no interest in it. It went down as low as 3% a few years ago. It's higher now, maybe it's 6 or 7%. But is there a sensible allocation for people, in your opinion, right now?
Yeah, I mean, we like the 5% range for commodities. I also think you need to have some gold or Bitcoin in your portfolio for what I call the 2025 fiscal reckoning. So I think in 25 we have a lot of fiscal decisions to make in the United States. We can't spend the money that we're spending. We've got Social Security coming up. The Trump tax cuts need to be renegotiated. They come up in 2025. And you've got the two candidates, or the two biggest spenders ever in US history, peacetime spenders. So I think the market is starting to worry about that. That's why gold's rallying so hard.
Mike, do you agree with Jan's point here that the reason we haven't seen much inflows into gold and commodities this year is because the data is still fresh and investors haven't caught up yet, or investors just not interested? Your thoughts on this?
The gold trade is much more about a flight to safety, in my opinion. And when you look at the commodity trade, it's broader based. Like the S&P, GCI, it's much more about the inflation trade and the growth of the economy. So I keep those kind of, in my view, a little bit separated.
So yeah, and I do too. Well, I do too. And so I'm medium bullish on commodities. I'm very bullish on you need some gold or Bitcoin in your portfolio. I've been saving.
Well, you're saying there's a different dynamic.
Yeah,
here.
I'm agreeing with Mike. I'm just following up, and I just say that our conviction on gold and Bitcoin is very high, because you need
and
to
gold
have
is a play
hedge,
on what?
A hedge for that 2025 fiscal problems in the United States. People around the world are buying gold because they think the U.S. government is spending way too much money. Right, it's not even close. We have the huge, largest fiscal deficit in U.S. history in peacetime.
It's a little more than 100%
full employment
of GDP.
This is like the Fed buying mortgage bonds in the middle of the hottest housing market a year or two ago. This is insane. The young people today are going to look back at this 23, 24 era and say, "What were you guys doing, borrowing trillions of dollars with full employment?"
Yeah, it's a tough situation.
And that's what people are worried about, that we print money to get out of this debt problem, boom, great for gold.
Yeah. Let me move on. Your Van Eck Semiconductor, it's the big big kahuna in this space, SMH, we talk about it all the time. That's what's getting the inflows, not commodities. It's had big inflows since November, in fact. You must be very happy. You collect a nice little fee for that. He's doing well. But it's been moving sideways for the last couple of months, and even NVIDIA is too. I know you don't comment on, stock trading and advise people, but any thoughts on what's happening
Well,
here?
semiconductors have become the heart of the AI trade. They're really the cleanest AI ETF out there. I don't know if Mike agrees with that. And a lot of these companies are, SMH just has the top 25 semiconductor companies, and they're super high quality companies. They've got competitive moats, they've got, and the real question for semis is, and they have become revalued from being a highly cyclical business with short product lives to these sort of, so it's part of the growth trade, and they have more recurring revenues, and they can just stay at high profitabilities even, despite some of the short-term stuff. Mike,
doesn't it amaze you that even with technology underperforming this year, that's where the money still goes? It's like they have a sort of a recency bias, investors. We know this, the behavioral economics, but they think that, oh, this used to work in the past, I'll just keep buying that, and yet we know that that's obviously a problem. But any thoughts on the flows so far? It's technology still.
I think Jan alluded to it earlier, but when we track flows, we see it very much, it's chasing returns. So we often caution our clients to almost think about flows as a contrarian indicator. As flows get really depressed, that's potentially an opportunity to buy, and vice versa. As flows get really extended, it might be time to pair a little bit. But I do agree broadly on the kind of fundamentals of the semiconductor space. I mean, it is a high-tech commodity in some sense, and right now the competition is not to such a level where they can push prices down. It's dominated by the top end of the market, and they control that pricing. And there's no indication that the demand for growth is going to change in that sector. So you have very clean balance sheets. You have a high moat, is a good way to put it, and they control that kind of pricing point. So until there's a situation where competition increases meaningfully in this space, where you can have some pricing pressure, it's hard to see that trade going away.
Yeah, and I got to ask you about bonds. You run a suite of bond ETFs as well. Fallen Angels High Yield Fund ETF, floating rates. You have a high yield muni. I had you on at some point last year, I forget when, you were very big on bonds and you hated commodities. And you seem to have flipped around here. You're big on commodities now and you don't like bonds? I mean, what's the issue
totally
here?
Flipped, yeah, that was exactly that conversation. And I think because of fiscal spending, I know everyone knows this fact, but the risk is to investors that it's not priced into the market yet. And that's why I think you need a gold hedge to that, but it's also a reason I think interest rates could go higher. So in your fixed income portfolio, go where the yield is, short term, and don't do the duration risk. Yeah, I don't think that's worth it. And remember, like So
everybody's advising, don't go out on the middle part of the duration, 5 years, for example, middle part of the curve, rather than the short end of the curve.
I would not right now. If I'm right about this fiscal budget deficits, because if the market gets worried, it's not. Gold is signaling it, and I would argue other things are signaling. We don't have time for that.
So for rates to go up, you don't necessarily, you seem implying, you don't necessarily have to have the Federal Reserve suddenly raises rates and makes a policy mistake.
The Fed doesn't control the 10-year.
Yeah.
Right? They only control the short end. And if investors around the world are saying, U.S., you're spending too much money, and the only way you get out of that debt problem,
how would they
every
manifest
other
that
country,
displeasure?
is inflation.
You could have a series of failed Treasury auctions that would drive rates higher. You could have a debt downgrade.
So credit
I'm trying to figure out, how do you get to this concern?
So credit default swaps, right, is the risk of U.S. defaulting on its debt. It went up during the financial crisis. It spiked last year. Remember when we had that budget standoff? It's still at high levels. Now, not as high as the financial crisis, but maybe let's call it half as high. So that is another indicator. It's like, well, that risk is not out of the market. Yeah. The last thing I look at, Bob, is EM local currency bonds against U.S. Treasuries. U.S. local currency bonds have been outperforming Treasuries consistently over the last 3 years, which is like That makes no sense because the dollar's been strong, but government bonds have not been great. I mean, there's the duration issue, that hurt them, but they're getting re-rated.
We got to go, but I'd be remiss if I didn't ask you about Bitcoin. You're one of the 9 new Bitcoin ETFs out there. HODL, folks. Huh? Get it? H-O-D-L?
Yeah.
That's very Jan von Ecke, by the way. Did you come up with that?
It's a long story, but
all right,
we got it.
Go ahead. So go ahead, give us some thoughts. Flows have been good.
So a year ago, I was pounding the table on gold and Bitcoin. Now I'm like, no, pound the table, but we're in a bull market, which means expect corrections of 20-25%. I would buy the dips. I think we are in a bull market for gold and Bitcoin. If you don't own it, buy on dips. Keep that part of your portfolio.
Mike, what are you telling people about Bitcoin and it's Bitcoin ETFs?
Yes, I mean, the flows have been impressive. And I think part of the outflows in gold this year, so just broadly in gold ETFs, can be due to the launch of the spot Bitcoin ETFs. I do think there's some people pairing a little bit of their gold exposure with the new crypto spot price products out there in the marketplace. And I think that's pretty evident in that first month of flows that we saw. Crypto, broadly speaking, I'm not ready to call it a safe haven asset yet. So I believe it's, if you just look at it, it's still more of a speculative asset class. It doesn't say I don't think it can get there. I'm not an expert in this space, so I really kind of just keep my opinions to myself. But I do think that it's hard to think of it as a safe haven asset when, it's generally speaking trading at a significantly high beta to broad equity markets, especially risky equity markets. It's hard to think of it that way, at least in the short and intermediate term.
Yeah, I find it hard to believe. It's a speculative. It moves along with like Kathy Wood's ARK fund. It's a sort of a speculative investment, wouldn't you say?
I don't think so. I mean, Bitcoin and gold both hit all-time highs this year. So they don't correlate super highly, but they follow the same macro forces. I mean, Bitcoin's got other things going on. It's got a tech element. It's also evolving as an asset. So anyway,
okay. We're not going to get into Bitcoin right now. I've said my piece on Bitcoin. I've said my piece on blockchain. Big blockchain bull. Bitcoin, not so much, but that's all right. Not time for that. As always, wide-ranging discussion. I've known this guy a long time. That's why I keep having him on. He knows a lot about a lot of things. That does it for this week's ETF Edge. My thanks to Jan and Mike. And we've asked Mike to stick around and give us his broader thoughts on the ETF business for the ETF Edge podcast coming right up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.